Is this readable or should I go into presentation mode?
It is readable. You go to
We can always expand on this, like, if
We
we
can
can
zoom
always
in and read it. Yeah.
yeah, we can
Okay.
Yeah,
zoom
yeah.
it.
In terms of housekeeping, we've already talked about recording. So I have your permission to record this session, and it will be used for the benefit of those who are not attending today. And just to kind of revisit, even for myself, just to learn from it and see how I can improve sharing such information. The first disclaimer is verbatim from the AIG group. So basically, we know that we are in a closed group. We know that and none of us is professionally qualified to be an advisor. We are just trying to help each other, learn from each other, and taking full responsibility of our own actions. So it's quite important. I thought I'll just put it out in any case. Okay, so in order that we dive into understanding the technical analysis, looking at the charts and trying to make a sense of these, let us first just take a step back and understand how the markets operate. And I have kind of oversimplified this, not in too distant a past. The stock exchanges used to be a very noisy place where hundreds of people who were members would basically go there, stand on the floor, and do buying and selling by just shouting what they had to buy or sell and the prices they wanted to buy and sell at. And literally there will be exchange of slips when there was an agreement on a price for a particular asset, and that would be a gentleman's agreement, and then those slips will be collected at the end of the day and a settlement will follow in a few days time. So the basic structure of that style of operating hasn't changed. Even today, exchanges have an opening bell, and there are members who actually walk down the floor and do the shouting bit. But what has changed over the years is that at the heart of every stock exchange, there is a engine which basically does the matching of buyers and sellers. That is the demand and supply. Okay, even before we go that, there's a little picture at the left bottom. When we talk about buying and selling, we are actually accessing the stock exchange in some form. But we as retail traders are not members of the stock exchange. So our orders are aggregated by middlemen, and there could be multiple layers of these middlemen. I will take an example. I have got an account at Trading 212, so have many of other colleagues here. They probably are not even members of stock exchange. They work for some other brokers who might be working for some banks, ultimately having a seat at the stock exchange. I think it is important to understand this because there are so many middlemen. How do they make their money? They taking some kind of a cut? Some of them even claim that they provide you commission-free transactions. There is nothing free in this world. So when they say commission-free, they are actually charging you through what we call a spread, which is a difference between buy and sell price. Through our platforms, which is provided by the platform provider, we have access to this market where we put our buy or sell orders at a particular price. So this picture in between is representative of, let's say, just one asset. Let's call it Tesla, for example. So for Tesla, there might be a number of people who want to buy Tesla, 100 at 460, someone says 1000 at 450, 5000 at 446, and so on and so forth. Likewise, there are sellers who would like to sell what they already hold. I'm not talking about short selling at this point in time, just keeping it simple, who want to sell at certain prices. Okay, so it's kind of a stack of buyers and sellers. Now that stack is kind of always moving and volatile depending upon the influx of such orders. A trade takes place when there is a match between a buyer and a seller. Okay, so if let's say there is a agreement on price and quantity, the engine does a match. Okay, so sometimes when I buy small quantities like 100 200, the matching happens at an aggregate level. Okay, but the engine knows where to direct those assets. So a trade takes place when a match between a buyer and a seller happens, and it is represented as a tick in the chart. Now, because it happens at a volume and a speed, which is like hundreds or thousands of ticks per minute, you need a mechanism by which you can capture that information in a decipherable form, in a form that makes sense. Okay, this continuous stream of data is presented in understandable form through charts, and we will come to that. Okay, but the unit of the chart is a tick which takes place when a trade happens, and a trade happens when there is a buyer and a seller match. The one thing that I would like you to remember from this slide is that never forget that there are two sides of a trade. So when a trade takes place, there is a buyer, there is a seller. Understand that these two people have got absolutely 180 degrees view of that market at that point in time. So because one is trying to sell it and the other is trying to buy it, it may depend upon the perceived value that one holds against the other. It can also depend upon their other situations like financial situations, their risk appetite, and so on and so forth, which we will come to. But the bottom line is that uh, when a trade takes place, there are two sides, and you should never forget that, because when you are buying something, you always hope it will go up, but the seller you bought it from, okay, must be thinking that that's it, it's not likely to go up. You have to try and understand his or her reasons as well. I'm just trying to put that into perspective. Next bit, what is then technical analysis? So technical analysis is a process of looking at the price information. So price information, the smallest unit is a tick, which I talked about earlier. A number of ticks can be collated together in a minute, in 5 minutes, in hourly, 4 hourly, weekly, daily, all that units, which we will come to later on. But they can be presented and they can form a kind of a graph on a piece of paper from which you can try and predict future. Whilst there is science involved in some of these predictions, the process per se is not scientific at all. Okay, what it means is that when you're looking at the past and trying to predict future, there are no guarantees. Then why does it work? What is the basis of using technical analysis as an aid to your decision making? One of the reasons is that the technical analyst people think, as against fundamentalists, although I'm of the school that both of the ideas should combine together to make a good trading plan. But the technical analyst people think, or they believe, that everything that there is to be known about a particular asset is already reflected in the price. Okay, so that's the belief number one, and that is why when a price tick happens on the chart, it is representative of the true value of that asset in that point in time. People are trading 24 by 7, and not only people, there are actually algorithmic based robos which are trading as if humans were trading. So the markets are up all the time, 24 by 7. If the price forms a pattern, why is it that it is likely to kind of repeat itself? One of the notions is that if a particular asset is in a moving in a particular direction, it continues to do so unless there is something significant which will force it to go in opposite direction or stop that flow. There is a fourth element which is about recency bias, that when we say and we see this kind of discussion all the time on our group chat as well, that an asset either falls or rises suddenly, there are many people who will say, oh, why it has fallen. Question behind that question is, people want to buy because of the recency bias, because it was somewhere, it has fallen 10%, therefore they see value in it. So there is that recency bias of what the price might do next. And the other thing that happens on price charts is that on the chart, because charts are a footprint of what has happened in the market, you are able to see where there have been massive imbalance between buyers and sellers, and perhaps use that information to predict the future. Okay, so that is the basis of why technical analysts seem to work. It in the end, because it is not scientific, it is kind of a self-fulfilling prophecy, because a lot of people believe in it and they take collective decisions based on those patterns, and their collective volumes create some moment in the market, and it kind of turns out to be true. Okay, so it's a little bit of that as well. When I talk of price, it can be represented in many forms. Simplest form is a line form. Okay, in any time frame, if you take the collection of data from exchange, all the ticks, put it together and make blocks of that data in let's say we pick up hours data from stock exchange. Let's say 500,000 transactions have passed through in that hour. All those 500,000 transactions will be clubbed together to form a starting price and a closing price, and how the price went in that in that time frame. That is reflected on the chart here. So this one is an hourly chart for a particular asset, but the line chart represents the closing price in an hourly fashion. So the closing price every hour is represented by a single dot on this line, and that's how this line is formed. From the line you can kind of make out that the price has gone up, then it has done a little bit of sideways, and then gone up again, and then started to come down, and then going flat again. It kind of gives you a picture of how the price movement has happened. So this is one way of presenting a chart. There is another representation which uses what is called as bar chart. So instead of a line, they use bars. A bar has got many elements. So it's got a vertical thing and got a two horizontal things sticking out of it. So one is an opening price, the other is a closing price, and there is a low and a high. In each time frame, all those orders that took place or the trades that took place in that time frame are represented in this single bar. You put all these bars together for a period of time, it creates a chart pattern for you.
So a quick question here. Can
Yes,
you hear
please.
me?
Yeah. Yeah.
So so this vertical line represent what time? Is it like a specific period of time or
Yeah. So it can be any time of your choice. In this particular example, if you see where my cursor is, it says H1 means hourly, 1 hour.
okay.
So each bar represents an hour. If 100,000 trades have taken place in that hour, it basically represents the high of that, the low of that, and the starting and the closing of the hour.
Got it.
But on any charting platform, you are allowed to choose your own time frame, and I'll come to that why time frames are important. My favorite one is what I call as candlestick charts. Okay, so it is not different from the bar chart. Candlestick chart is why it is called candlestick, because each of these things look like candles. A basic unit in a candlestick is a candle which is formed of an open, a close, and a low and a high. The only difference from the previous one is that in the previous one, the opening price was always on the left and the closing was on the right. Here there is no such thing, but it is the whether the price has gone up, that is, if the price is opened at a certain place and closed at a higher, it has gone up. So it is represented in a particular color, say green here, and vice versa in red. Just by the color of it, you know where the price opened and where it closed. If it is red, that means the open is higher and the closure is lower. And if it is green, the open is lower and the closure is higher. The wicks which are coming out of this candle, they represent the high point and the low point in that time frame. Each candlestick is representing all the trades that have taken place in that hour. Okay, now if I was to change it to 5 minute, then I will say candle represents all the trades that have taken place in that 5 minute period. So this particular chart, it is for hour, taken for hourly. You need to understand this because from this, all the patterns and everything that we will do in rest of the session will be based on these notations, right? I'll pause now and take any questions at this stage.
Sorry, can you hear me?
Yes,
Yeah, so on this technical charts, the thin line that comes in these candlesticks, are they real trades or is there
the
any
wicks you mean,
significance to that? The,
the
the
wicks.
thin ones here.
Yeah. So basically, if I take this candle, for example,
Uh,
you're talking about these wicks, right?
yes,
These are representative of real trades. And when we talk of huge volumes, for all you know, majority of the volumes might be taking place in these wicks. So these are not to be ignored at all. These are very much part of that, all the trades that took place in that time frame. The body only represents open and close. Okay, the total number of trades that took place are represented from the top of the tip to the bottom of the tip. Okay, so they are very significant. No, don't ignore them. So sometimes I've seen people, they just ignore wicks and they're looking only at candles, and it is not right, because you are missing out big piece of information about which you do not know. Majority of the volume might have taken place here. Who knows? We don't have that,
Yeah.
not in this chart at least.
What I observed is, I might be wrong, is when I put limit orders anything as such,
Yeah.
sometimes they get closed, but sometimes they don't get picked up even though the VIX goes down or up.
Yeah. That is your platform provider playing tricks with you. Okay.
Okay.
Yeah. See, as I said, we are separated from the exchange by multiple layers, right? So
Right.
we are in the hands of the platform provider that we use. Okay, so that is the access point. That is the guy who's providing us the price, who's basically doing the deal for us. So it is up to him or the software that he uses, which will give us or not give us the entry point. So on the exchange price, you might see that it touched your limit price, but this guy, because he's taking a cut of a particular tick, he's not giving you that price. Yeah.
Understood. Thank you.
Yeah. Okay. And that's where, when people talk of commission free trading, that's where they get their cut. Suppose you want to sell it at, let's say, taking previous example, something at 420, he will
Yes.
sell it at 420 for you only when the exchange shows 422. And that 2 pence is his price.
Right. Okay.
Yeah.
Got it.
Okay. So very important to understand that, because uh, all these middlemen, they are funded by people like us. Their major source of income is the transaction cost that they capture from us.
Yeah, I understand. I was under impression that it could be the shots and all other people playing, the
No, no,
shots
no,
and
no,
shots.
no, no, no,
Okay,
no, no, no.
understood.
I mean,
Thank you.
there is so much of automation on this that there is very limited scope of manual interventions in this. If they have programmed a certain, certain amount of cut, they will just, it is programmed, and it's not interventions.
So could I ask a question? Which
Sure.
companies are good for a small spread? Because the spread is important, because that's where the money is made, but that's where the money is lost by the investor.
Yeah, correct. So I think you have to do your research, to be honest. So for my kind of trading account, I'm using T212, and they seem to be okay.
Okay, thanks.
Yeah.
And I think it again, I mean, just my 2 cents on this. The spread trading is mainly if you're doing the day-to-day thing,
Yeah.
then all those
Correct.
important little ticks will be really important for you. If you're
Absolutely.
like buy to hold kind of investor, you don't, I mean, you're
Yeah.
holding for like years and months together, for example, 20, 25% plus return,
Yeah.
then those small ticks should not really be all that important.
Yeah.
So you would look into things like liquidity and all those things. That's more for
Absolutely.
the day traders.
Absolutely. Time frames matter. If you are into kind of too much trading on a daily basis, then every tick matters, and therefore you have to be very careful. But my own learning over the years is that it is not for people like us, to be honest. We shouldn't be doing that, because if we are trying to do day trade, then we are pitching up ourselves against algorithmic, trading, and you just can't win. There is, I wouldn't say it's impossible, but it is almost going there in the realms of impossibility, because you are fighting against well-trained algorithms, and those people have the first-hand knowledge of what's going across the world geopolitically and so on and so forth. They've got tons of people doing research. It'll be very difficult to win on a consistent basis. You will have an odd winner, that's luck, right, in this market. But that's my perspective anyway. Day trading just.
Jadeji, very quickly, I mean, I don't know if I'm pulling the trigger too early, but will you be sharing insights on like how to interpret these candle charts or?
I will, yes.
Yeah,
That is the
okay.
crux of the thing. I'm just building up to that.
Yes. Okay.
Sorry, just one more thing. I mean, so the VIX is basically if the high and the low are within the open and close, then there will be no VIX, right?
So if there are no wicks, that means this if let's try to find out something without wicks. Okay, so this candle here
Yeah.
is more or less without wicks. Okay,
Hmm.
what it means is that the price opened here and closed at the top, which
Yeah. So
means there was so much of buying interest at this stage, the price didn't come down at all from the
okay.
high, and then the hour switched and then it went to the next one.
Yeah,
but
makes
but
sense.
all I'm saying here is whether small or big, wick should not be ignored.
Hmm.
And I'll show you when I do analyze, when I draw up trend lines, I will take into account wicks for that particular reason. Okay,
Sure.
so uh, I think time to move to the next one. So first thing, let's talk about candlesticks themselves. So candlesticks are the basic unit that form the charts, and as I said, each candle represents a period of time. A lot of people have done a lot of research on candlesticks, that if a particular kind of candle forms, then what it could mean for the price for future, and it is based purely on research. So you could also develop your own way by doing a lot of research on existing charts, or looking at future charts and see whether you can capture a pattern and give it your own name. These are some of the popular candlestick patterns. The first one here is called a hammer, for example, and I'll show you examples of hammer when we go to charts. A hammer is a bullish kind of a pattern, where the candle looks like a hammer, which means it's got a wick at the bottom and a solid top. Let me switch to actual charts and see if there is a hammer here. Oh, this is a perfect hammer, this one here. So this one, there's a long handle and there is a solid top base. Now, if I were to interpret this, it basically opened the opened the price here. In between, there were a lot of trades that took place between this, but they were all the price of all these trades was rejected and it closed at a higher point than it opened. So that forms a hammer. They call it hammer, and every time a hammer appears, they say that the next candle will also be green, and the so whatever was happening before, it will turn around and it will go in the opposite direction. So it is called a bullish trend. In this particular case, it has happened. So there is a hammer, and then after the hammer, you see green candles taking the price up. But does it happen all the time? It may not happen all the time. That's the thing that you have to always remember. And it is all probability that every time you see a hammer after a downtrend, then that is a sign the trend will reverse. That means for us traders, if we see a hammer after a bearish pattern, after a bearish trend, then we can start taking buy positions. That's what it tells us. But will it always give you success? That is not guaranteed. But people have done research that the probabilities will be in your favor. I don't want to spend time on each one of these because they all are available, very easily available on Google, and you can read. The one that I find most interesting, somebody named a pattern called Harami. I'm sorry, it just kind of makes me laugh every time I read it. There's something called bullish Harami. So bullish Harami is a pattern which is like this. After a downtrend, if a green candle appears in such a manner that it starts from a price above the previous close, then the entire price action stays within the candle size and closes above. So closes a green candle. When this kind of a pattern happens, that is also supposed to be a bullish kind of a signal. And people have done research, probabilities are in your favor. And this is just one example. So if you want to do research, you can just look at these and see how they are used. Do I look for these in my analysis? Yes, I do, as an additional confirmation. If there is something like this, I will use that as an additional confirmation. It will give me a little more confidence of going into or taking a position. These kind of candlestick patterns have been well researched and they seem to work. Again, they work because a lot of people will be taking similar positions, and that itself sometimes takes the price in the direction. I would like you to kind of spend some time just to do a little bit of research. I can take another session where we can talk about each of these, try to find them in actual charts. Let me repeat what it is. So first condition is there has to be a downtrend. So you can clearly see on the chart that the price has been going down for a while. Then previous candle is a red candle, which means the price has opened up and gone down. After this candle, the price makes a gap. So suppose this was a daily candle, then on the daily candle, if it makes a gap, which means that it opens up slightly higher than the previous day's close. So there is a gap, and then closes at a higher but within the size of the previous day candle. So that these two candles together form a harami, but it is supposed to be a very bullish kind of a signal. Use it with other things, right? So it is not scientific, so it doesn't work 100% of the time, but you'll find quite a probability that it will go up, and at least in short term you will not lose money, and you'll get the chance to move your stop losses to a break even.
So the
Again,
time frame for this one is 1 day you're talking about, right?
no, it could be
Daily.
anything. It
It could be
depends on
anything.
your
Okay.
time frames, but the pattern is applicable for any time frame.
So which time frame is most commonly used here, like in
I-
general?
it's a matter of personal choice. Okay, so I will come to I will share with you what I do, but it's a matter of personal choice. um, the larger time frames you choose, the longer term play you are doing basically. So if your trading style is I want to kind of do solid fundamental research on an asset, and I want to kind of keep it for long term, then you're looking at higher time frames. But if there is something that you're not sure about, but you still want to trade and get the benefit, like a few days ago, Jeet Z was buying and selling every swing of Tesla. So then you have to look at shorter time frames, because otherwise, if you're not sure, then you are in danger of losing money. There is nothing ideal, but I'll come to how you can kind of identify your own style and come up with a time frame which works for you. And I'll show you how to do that.
Thank you.
Just one quick question. So,
Yeah.
so in general, looking at that different harami patterns, I'm more
Mhm.
interested in. So for example, somebody like short seller, he will be more interested in that type of thing, bearish harami
Yeah,
or something.
yeah, yeah. I mean,
Is it?
see,
Yeah. Is that?
see, short sellers. I think they're a completely different breed and beast.
Yeah,
So
yeah, yeah,
they sell what they don't own, right?
yeah,
So
yeah,
they basically put up a lot of money, basically
yeah, yeah,
betting against a particular asset class,
yeah,
and then with the hope of buying it back when the price falls, right?
yeah.
Yes,
Okay.
if somebody wants to short it, that's what they will be looking at. So I will now move on to charts. Before I go there, I just wanted to present a picture to you. In these pictures, do you see patterns repeating? If you look at the entire leaf, there are branches coming out, and each branch is like a replica of what this entire picture is. And similarly, this one. There is a term in mathematics called fractals.
Mhm,
So a fractal is in mathematics, a fractal is a structure or a function which is similar to itself, which replicates itself. So in nature, you'll find a lot of these examples. Somehow, I got these pictures because charts are also like that. When you look at a chart and you look at different time frames, you see similar pictures emerging, albeit when you change the time frames, what you saw as a very solid uptrending thing might be looking downward or so on and so forth in different time zones, time frames. But when you look at different time frames, so when I go to this chart, whether I look at a 5-minute chart or a 15-minute chart or a 30-minute, so each one, it's a similar picture emerging, right? Yeah. So uh, again, it helps us to understand the way the price movements happen, and just be aware of that. In any time frame, a similar pattern will emerge. I mean, the price will never ever, hardly ever move in a straight line. They will always form these patterns of going up, down, up candle, down candle, forming these patterns. And it is up to us to start deciphering. Our responsibility is to predict what's likely to happen from this point on. And we have three options. Option number one is whether I want to buy. Option number two, whether I want to be a seller here. Option number three is do nothing. And that's a valid option as well. So coming back to my picture, I just found it quite fascinating. So now coming to time frames, in whatever time frame you look at the chart, you have to go at least 1 to 2 higher up. So if you're looking at a 30-minute chart, I would like you to go to hourly chart and a 4 hourly chart. Do you see how the picture changes? So in a 30-minute, it is the same chart. It is USD Japanese yen from Jan of 25 till now. In a 30-minute chart, it kind of meandering along sideways, no clear upward direction or downward direction. As you can see, it has barely gone anywhere really. It's kind of operated in a very small channel here. But when you go into hourly, you can kind of start seeing that it is trending downward. Price on the left was somewhere at 158.56, and now it is 155.50. So it has kind of gone down gradually over a period of time. Hourly gives you a completely different picture. If you go to 4 hourly, the same chart looks like as if it's going up. Okay, having gone up this far, it is kind of right now in a consolidating sideways movement. So the three pictures give you completely three views of the same asset, and that is why it is very important to look at things from multiple time perspective. So when I say that you have to look at the big picture, it's almost like, let's say you're in a forest, right? If you are down on the ground, you see a lot of trees and bushes and, a little pathway somewhere going somewhere. But when you're in the midst of that forest, you do not know which direction you're going on. But if you were put on a helicopter and you had the opportunity to rise yourself above the forest, then you will be able to see the landscape, okay, where the path is probably going, where is the water flowing, where the hills, and so on and so forth. So when you see the big picture in a helicopter, it gives you a complete or a better perspective. A higher time frame graph or a chart in a higher time frame gives you that big picture. So going back to my chart here, so comparatively I'm saying 30 hourly and 4 hourly chart. The 4 hourly chart, which is half a day per candle, is basically telling me that this price has actually gone up. Okay, so if I was to draw a kind of a line here, it's gone up here, and then it has kind of moved sideways afterwards, roughly. So it has made upward movement, and since since 17th of December until now, it is making sideways movement. It can be viewed in different ways. If I go further up, if I lift myself further up, this is the period we were seeing, right? In this period, the price has gone up and making sideways movement. It tells you a completely different picture. So to the question of time frame, my suggestion is, you see, for people who are dealing with stocks, as we are, most of us are dealing in stocks, looking at 15, 30 minute, 40 hourly chart is probably pointless. My recommendation is to look at hourly only for decision making of buy and sell. But for the bigger picture, look at least a daily and a weekly chart. Okay, that's my recommendation. That's what I do myself. So I look at multiple time frames, but the big picture is never to be missed. So the big picture will tell you what to do, whether you want to be a buyer of an asset or it has kind of from your perspective reached a reasonable level of value, and therefore you want to take some profits and want to become a seller. But when do you want to do that? That will be decided in smaller time frame, because that gives you more frequent action of the marketplace. So um, I'll come to that those examples as well. So always use multiple time frames and never miss the big picture. And by big picture, I mean higher time frames. The higher the time frame, the bigger the picture. So in this particular case, let's say in this particular case, if I was to take a daily cut, this is only a small piece of price action. But if you see, it has gone down, then it has recovered almost 75-80% of it, then gone down again, and then into a new trend. Where is it likely to go from here? If I was to take a punt today, I will actually probably not buy, but if I had it, I will try and sell it, because this uptrend is kind of broken. It did sideways, but now it is trying to break down the previous swing lows. So that's how I will interpret it, and I'll come to that a little later again. How to draw trend lines, and ultimately, I want you to have the sense of, can this be used as an actionable information, and I, that's where I want to get to slowly. Okay, in this session, and if we need another session, we'll do that as well. Okay, so never miss the big picture. Big picture represented by high time frames, right?
I ask a question, Jatirji?
Yes, please. Yes, please.
So you said you use, a 1 day or a 7 days picture to, draw the lines and see how the trend is going.
Yeah,
But for how much length of time? Say 1 year, 6 months, 3 months? Because that would give us as an idea as to where we are
absolutely.
going to.
Absolutely. I think I'll also come to that bit. See, when I'm using this information to draw inferences as to what will happen in future, or where I'm going to take a sense of high probability trade. Okay, I'm also looking at the past. Okay, and as much as past as possible, based on your platform provider. There is a concept of identifying demand and supply imbalance, which I come into next slide. When you are making a decision, you want to look at the previous demand and supply imbalance, so that you are able to, while taking the trade, you are able to decide where do you want to sell it, if you were to sell it, or where you want to buy it if you were to buy it. To answer your question, as far back as possible, but at least to the point where when you are making a decision here and you want to draw lines, it should hit your chart. So it should not kind of go into vacant space. So say for example, if let's say if my my price action was, let's say, here at this point, forget this bit for now. I'm talking about this big green bit here. Suppose I was on this day, 8th of December, or whenever this section was. Suppose I was on that day, I see a great green candle, and I think, okay, there's a huge interest in this asset. There are a lot of buyers. The price opened here and closed here. It looks like, the community is agreeing that it is a good thing to have. So therefore, I want to be a buyer. Now, if I want to be a buyer, I should also know when will I sell it so that I can make a profit out of it. Now, in order to sell, the price has to go up. Now, for me to find a price point to sell, I have to look back on all the way up to here, and not even here. This isn't good enough a profit. So to answer your question, when you're making a decision about future prediction of a price, then from that point, let's say this was my future target 162, I have to look back whether this asset has ever touched 162, and when was it. If it has not, then it is less likely. If it has, then at what level. To answer your question, the idea is to have as much data as possible as the platform can provide, but while making a decision, at least to the point when you can meet a previous occurrence of that price. Is that making sense?
Yeah, I think yes.
Now I think I'm getting
Sorry,
to.
just one thing, Jaydeep, the
Yes, yes.
colors of the candle. I mean,
Yeah.
you want to just elaborate on that one? I mean, because I had a big misunderstanding about the colors of the candle. What does green represent and what does
Oh,
red represent?
so red
Right.
represents price basically going down, meaning opening at higher, closing at lower. That means it has gone down from where it opened. That is represented by, and I can always change these. It's up to
Yeah.
me. I can always, if I want to call it white, it will be white. But I think because we are in this business, red means a down day, and green means an up day. I've kind of chosen to.
Yeah, it's basically the closing price, right? I mean, which shows the candle color.
So for a green candle, the closing is always up. For
Yeah.
a red candle, the closing is down. That's why it is
Yeah.
red. So again, I think going back to this picture, on a green candle, open is at the bottom, close is at the top. And that's why it is green, because the price has opened low, closed higher. In
Yeah.
the red candle, it's the other way around.
Yeah.
So now I'm just going to kind of and do some analysis with the charts that I have. Unfortunately, it is not a lot of thing, so not everything might be available there, but we'll try. I talked about this candlestick patterns already. So I spoke about two. I talked about hammer and I talked about harami, but there are quite a few others. You can just Google and you'll find a very easily comprehensible description of those. Can they be used on their own? I would suggest probably not. Just use it with something else, right? Always use more than one things to increase the probability. Okay. So, but candlestick patterns are just that. Now, we talked about multiple time frames. Now, let me just come to the next thing, which is the trend lines. How do you draw trend lines? So I'm just looking at this picture, and just by a visual picture, a visual look, I can say that the price has gone down for this asset, USD yen. I can say, just by looking at it, I can say it is trending. But there is a technical definition of trending. What it says is that when something is trending down, it is defined by making lower highs and lower lows. Okay, so just listen to it carefully. Lower highs and lower lows. So this is the price started here, makes a swing high. So this is a high. So this is our first high. Let me Let me mark it by a rectangle here. So this is my first high. Then it makes this a low, a swing low. So now we are getting into the crux of analysis. So a high and a low. The next high is, the next swing high is here, which is lower than this high. Okay, so it's a high, it's a swing high, but it is lower than this high. So it is making a lower high. It is making a lower high. And the
Yeah.
next swing low is here, which means this low is even lower than the previous low. So it is making a lower low. So lower high and lower low. The technical definition of a trend is when the price is making a lower high and lower low, and it makes a consecutive series of that. You have to at least have two of those to establish that there is a downward trend. Okay, so that's the technical definition. And if it was the other way around, if it was making higher high and higher lows, then it will be in a rising trend. Having established that, and it is visually also, it is kind of looking, when we look at the chart, we can say, oh, it's in a downtrend. But the technical definition is this, that it needs to be making lower highs and lower lows. Now, when you try and connect this, and I'm taking the wick into consideration here, but for a downtrend, you have to draw the line at the top of the price in such a way that it touches at least two highs, and the entire price action is below that line. So then such a line is called a trend line. Now, clearly you can see it is not horizontal. It is moving from top of the left to the bottom of the screen on the right. So it is in a downward trend. The price of this asset in this time frame is in a downward trend. That's how you establish it. So right now, when it is in a downward trend, do I want to be a buyer of this asset? The answer is absolutely not. And I'm looking at a fairly high time frame here, hourly time frame. So I'm not going to be a buyer of this. So what I will be looking for is, I'll be looking for a break of this trend. So now I've just increased the time frame. It gives you a different picture. And the line I draw is here. I can also see that the bottom of this price action is kind of flattening now. What it means is that it is not making bigger lows. So it made another low here. So it made another low here. But currently the price is actually nowhere near this. It's in the middle of this channel. Okay. So if I want to be a buyer of this asset, what I'm looking for is reversal from this downtrend, and that reversal will be confirmed when the price. So I'll be looking for two or three things here. Number one, when the price makes a next swing, it does not go below this. That means the theory of, the very definition of a downward trend is lower lows and lower highs. So if it doesn't make another lower low, that means I'm good. It's a good signal. The next thing I will look for is that the price somehow breaks this line, which is the trend line. So if the price breaks this trend line, so it makes a higher low and it breaks this trend line, then I'm good to go long on this asset. So I'm good to buy this. And why I'm saying that is because overall, in a higher time frame, it is an asset which is going up. It was only doing a sideways movement here. There was a momentarily trend which was to the downside, which is being broken. Therefore, I want to buy this asset. Okay, so that's how the decision process takes place in my head. And I'm looking at multiple things here. I'm looking at multiple time frames. I'm looking at trend line and trend line break. Let's see if I can find something which is completely of a different nature. Yeah, so here again, if you see on an 4 hourly chart, high, lower high, further lower high, lower high, lower high, maybe lower than this. So if I was to draw a trend line on this, I'll have to draw in such a manner that I take 2 points. If I did this, that will not be a good trend line. Why? Because it's cutting this price. I have to draw it in such a manner that the entire price action is underneath, and it also matches it satisfies the criteria of at least two lower highs. So this is clearly trending downward. But from this point on, oh, this is made an engulfing candle here, which is a good positive reversal sign. From this point onwards, if you see, now it is making, so this is it's a swing low here, and next swing low is higher than this. So it is making a higher low. This is a high and it is making higher high. So it is making a higher high oh sorry, higher high and higher low. Do you see that in this structure? Let me
Yes.
just, this is your swing low. Next swing low is higher. So higher low. And if you look at highs, the one high and the next high is this. Clearly, by the definition of the trend, now from this point onwards, it is making a uptrend. Okay. But the price action is still within the overall downward trend. There are two things I can do. If if I was a shorter playing in the currency market, I'll try and short it here to just see whether it. But if it penetrates through, then it's a good long term uh, long position. But that's how I kind of draw my trend lines and play with the play with the trend. I can do a whole session on just trading the trend. But the way to once you draw these trend lines and you look at the overall picture here is not very pleasing. It is the pound is going down. So I would not like to be a buyer in this and in any case. Okay, so I will always be looking for shorting opportunities if I can. Okay, so because the higher time frame tells me that it is a not such a good asset to have at this point in time, unfortunately for pound. But if the higher picture was telling me something different, then I would, what I would do is I would look for the next swing low to touch around this line and then take a long position. So that's how kind of but again, it is not just one thing that I take into account. I basically look at least two to three things coupled with fundamental information that comes from other friends and colleagues. So that's how a trend line is played with. Any questions on trend
Jaidev,
lines before I move to next?
Jaidev ji,
Yes, sir.
this is very insightful, seriously. I just had one question. So, for the technical analysis and for the trend analysis, do you think we had to assume that everything else remains same in terms of like the macros or the fundamental news and everything? Because
Yeah, so
otherwise, things could be changing because of like the pound, for example. I mean, the
absolutely.
recent shift has been because of the Trump taking over
Yeah,
or the way UK economy is going, the interest rates and everything.
yeah. Yeah, so I think so. You cannot ignore the macroeconomic fundamentals. You will ignore them at your peril. Okay. The basis of technical charting is that everything that is to be known is reflected in the price anyway. So everything is discounted. So today's price already discounted the fact that Trump was going to be the president, although he just took oath yesterday, right? But it was decided in December, and from December onwards, people started taking positions on that basis. That said, I will still be very careful. I mean, you cannot you cannot use just one aspect to take your decisions. You have to create a method which takes into account all the factors, and fundamentals are a solid ingredient of that. So I will say take into account both things.
Got it.
On a
Right.
day when you're not sure, you have a third option, which is sit on the sidelines. We don't do it often,
And many
unfortunately.
and many times, I mean, the beauty, or I would say not the beauty, but the flip side of the market is that market tend to price in a lot of things well
Yeah,
in advance as well. Forget about the past.
yeah,
I mean, for example, people started even factoring in like, okay, what will be the next Bank of England's action, for example, or what
yeah,
will be
yeah.
the
They,
Fed's
they
next
do,
action.
they do, and
So
when
that is
that
where it
doesn't happen,
becomes
it creates
even
a imbalance. Yeah. Yeah,
yes,
yeah. So that's the next thing I want to talk about. The how to read imbalances in the demand and supply, and use that to your information to your advantage. So that's the next thing.
got it.
Any
Thank
more
you.
questions before I go to the imbalances? Any more questions? Are we okay for time, or maybe we should do it next Tuesday and I start from here.
So carry on for another 15-20 minutes.
Yeah, yeah. 15 minutes, fine. Yeah.
Okay, so today let's cover this next topic, which is identifying imbalances, and then we'll stop.
Okay, yeah.
Yeah.
For
Okay.
this, can we take anything live example? The known stocks, for example, the swing, what's happening over the last 2 days, be it
Yeah.
Netflix or Tesla,
So
whatever, so that we can have a glimpse of it rather than trading the currency.
yeah, unfortunately, see what happened is I did this in last couple of days when I was looking at any provider which could provide me MetaTrader, because I'm conversant with MetaTrader as a platform. Now, in the past, I have done stocks on MetaTrader, but this time around, when I opened a dummy account yesterday or day before, it is not allowing me to select a stock. In the past, if I was to kind of open a chart here, let's say open new chart, it will actually give me stock options, but currently it isn't for some reason.
Understood.
Yeah.
Okay, no worries.
I'll have to figure out if I can find some other platform. Unfortunately, the platforms like Trade, 212, etc., they are very basic in their nature.
Understood. Even the
Uh,
Yahoo also, you can see the candles and see the trend, but I'm not sure whether it will help.
let me see if I can find something for the next session.
Okay.
So now let's come to the next topic, which is identifying imbalances in the demand. So for that, let me take you back to the first picture I presented. Imagine that stack full of buy and sell orders. Suppose we are dealing with an asset which is highly in demand, and there are not many sellers. So what is likely to happen on to this stack is that there will be lots of buy orders, but very few sell orders. In an auction situation, what is the most likely thing that will happen? Because there are no sellers there, the buyers will then raise the price and they say, okay, we are willing to go, let's say from 460 to 465 or 70 or whatever, right? So they will start escalating the price. Now, if the sellers stay stubborn, then the buyers have to go up to them to meet them, right? And that basically
Yes.
raises the price. So when there are too many buyers or too many sellers, that is reflected in how a candle appears in a time frame. Going back to our kind of picture here. So when that happens, how is it represented in the chart? In the chart, such a situation is represented by relatively long candles. When I say relatively, it is in relation to the rest of the candles in its proximity. Okay, so if you look at this candle, for example, so if you look at this whole price action as a whole, price action starting from this point to this point. So started with a very small green candle, then another green, which was bigger, even bigger, then a little pause, another bigger candle, and so on and so forth. So see, what I would like us to do is that rather than looking at candles in charts as just you know a picture, we have to look at the story behind it. What is it trying to tell us? And from that story will emerge your bias, which is, oh, it is doing pretty strong here. Now this is only 4 hourly, so if I take two, so this is one day, next day, following day, so about 3 days of price action. So if I was to look at it in daily, it will represent two or three candles, right? Now this clearly is representing a imbalance between buyers and sellers. This area here, so I'm marking this area here because this is where it started. Are you with me? This is
Yep.
where the action started. So the action of making these big strides ahead started here. That means at this point there was an imbalance between buyers and sellers. So now I want to take you back to that picture, this picture. Imbalance means there were orders there, right? It was not that, it was only because there were no sellers, there are too many buyers, and buyers kept raising the price to have a deal, but all these other orders are still there. So what it means in chart terms is that in this area there are still buyers, because some buyers could
Yes.
get the deal but the price went up, but there are still some buyers still sitting in this area. So when price comes here next time, what is it likely to do? It is likely to grab those buyers, or those buyers will grab the price because they're still here because of the imbalance. Okay, so what happens is that if I extend it here, so if I extend it here and I'm now at the right edge of the, so here is my decision on this particular asset. I can see that it is making a trend, higher low, higher high. Trend, technical trend definition is done. It is making higher lows and higher highs. Okay, so I want to go long on this. Where do I want to go long on this? It is trying to, the price is very close to visiting the trend line, and it is also falling in an area where there was a previous imbalance. So I want to buy this asset somewhere at this price. What I'll do is go into my platform, place a limit order, buy here. It's in a rising trend line, and it is revisiting an area where there was a previous imbalance. So I'm mixing two things here. I'm mixing trend with imbalance in demand. So two things are in my favor. It can still go wrong. However, there's a better chance of it being in the, if I go further up and if the overall is in uptrend, then that will be a third factor. The fourth factor could be this is USD Japanese yen. So if there are some macroeconomic level things which are suggesting that the US dollar will be stronger than yen in coming weeks, then three things, eyes closed, take a long position. So that's how you get the probabilities in your favor.
So
Is
I'm just didn't
So,
I didn't
so yeah,
understand how did you find that imbalance at that area? I mean, what is
okay. So let me repeat.
you can just
So
revisit.
yeah.
I mean,
yeah, yeah.
I
Okay.
had the
So
same question, like, how did you identify that
uh,
there is a imbalance there?
okay. So how I identified is by I started in a smaller time frame where I saw. So the first thing you notice, the imbalance. Okay, let me just go back to the picture. When do you think in this tech imbalance happens? When there are more buyers than sellers, right? We agreed
yeah,
to that, right?
yeah.
Now that is reflected by the size of candles on the chart. Okay. Now, where do I see long candles in relation to other candles? So if you see the entire path here is candles small, relatively small, but here it made big strides
Yeah.
in this area. So the big stride is done by big money, which means that there are buyers wanting it to go up, right? So
Hmm.
this is how so after a little pause, when there are big strides in the direction of the trend, that is where the imbalance lies. On the daily chart, if you see, it is basically a green candle, a small red candle, and then big strides. So that is where the area is identified. Okay.
Okay.
Now, as a normal rule, I would like to see at least one candle in opposite direction to form an area.
Okay.
Yeah. If it was all green, I will probably use this as my area, but it is still the same area, right? Okay.
So,
The next area of imbalance is somewhere here, which is also on the trend line. So sometimes when I see these kind of patterns, I call them beautiful because, and you might have seen in, when I post my messages, oh, there's a beautiful pattern here, is when, two or three things align to tell me that it seems like, probabilities are in favor.
Hmm.
So
sorry,
yeah,
Jaydev, one quick question on that one.
yes,
So,
yes, sir.
so I understand, to reconfirm my understanding, what you're looking at is those big green strides,
Yeah,
which shows that the stock is going up.
yeah,
And then before that, you check if there is any imbalance candles in
correct,
there.
correct.
Okay, okay,
Yeah.
understood.
So if I was to draw something in the opposite direction, exactly the same logic, that is here. See the size of candles going down. So by that
Yep.
corollary, now if I was to extend this, so the next time price hit this area, there was an immediate pullback. Okay. Now, unfortunately, it didn't work all the way, but there was a pullback, right? So sometimes when you take trades based on imbalance, it will at least give you breathing space so that you can move your stops and you can make decisions. Because if it, by that time, you will also see that it is forming a different trend, then you will not take the trend, but a trade. But if let's say it continued to fall, the fact that there was an imbalance here and the next time price revisited that area, there was an immediate bounce back. Same thing here, a little area here.
Here, can we also see that there was a lower high and lower low, and which is why the price kept coming down?
Which portion are you talking about? This one?
Yes.
Yeah, yeah. So this is also, say this point from here to here is a clear downtrend, right? This point from here up to here
Yes.
is a downtrend until it is broken at this point. Yeah,
Yep. Yep.
yeah,
Yep.
absolutely. So yeah, I think enough for one day, right? In terms of trying to grasp what has been presented. See, ultimately, you have to kind of make a make a story out of looking at the chart. Chart is a living thing. It is like I said. If you look at the right edge of the chart, it is. Uh, do you see it breathing here? Let me reduce it to 1 minute, and you'll see. You see the point here?
Mhm.
See, this one here, the last candle.
Yeah.
Yeah.
So even though it is like close to 10 o'clock, it is somewhere somebody is trading, right? So
Mhm.
Yeah.
charts are a living thing, and when you look at them, they tell you a story. And I think we need to construct a story and see if other things are aligning with it, and then go with it.
Yeah.
Yeah.
So,
So
Got
for
it.
the next session, I think, Jaidev ji, if you can revisit the imbalancing again, I think that would be helpful.
Yeah,
That's
so I
right.
think what we can do is maybe next time we start with the looking at charts and start with the demand supply imbalances and look at even more examples. And I will see if I can get some of the stocks that we deal in, like the Sophie, Teslas, and some of the popular stocks that we deal in as a group. I'll try and get those charts ready if I can. Yeah, what if I bring static charts? They're not live. Static charts I can bring because I can bring a picture from my platform and
Uh, tell you, I don't know, it
Yep.
might help, but when you are showing the charts and things, I put in Nasdaq 100 on the screen just to
yeah,
see, because that I know that US would be trading at this time.
yeah, yeah.
Um,
I mean, do you want to show it to us? And maybe we can look at some. Shall I
yeah,
stop?
sure. Yeah, I mean, I got it on my other screen, so let me join from that monitor. Yeah.
Okay.
Let me join the meeting. Give me 2 minutes.
Yeah.
Yeah, couple of
It is,
questions.
how long you have been? It's more an art, is it?
It is in a way. It is. Yeah.
How long you have been doing it?
Not. So I'm an IT professional by the way. I started my career as a programmer and have been in IT for 30 odd years. I started this about, I would say, 15 years ago, maybe.
Okay, fantastic.
Yeah, 2008. When during the big meltdown. That was, I think, the first time when I started seriously, and
Excellent. I mean, once you point something, then it makes sense. But then to find those patterns, that's where you
that's where it takes practice. So
yeah.
I think we all can get to a point where you look at a chart and you can see two, three things there. Uh, yeah, yeah.
Right. Couple of questions. I think this is very useful, first of all. Um, but are these charts more relevant in certain kind of shares or companies? For example, more stabler companies like, let's say, Microsoft, right, versus something like something like Sophie, or some penny stocks and all. So I believe that these are more relevant for stabler stocks, if that
So
is.
a very, very good question. I think the volume matters. Okay, so let's look at this scenario. Let's say we have a penny stock where are only 10,000 outstanding stocks, okay, shares, and two or three individuals control them. They can do whatever they like with the price.
Correct,
Okay,
correct.
so the chart patterns and all of that goes out of the window straight away. So there you have to look at the fundamentals.
Because I think we are talking about averages and aggregates here, right?
Yeah, correct.
And if we have smaller figures, then it'll mess up the
Yeah,
whole averages,
yeah,
right?
yeah,
So, and second thing, if we
yeah,
go at a really small segment, which is, let's say, minute,
yeah.
then I think it's not a right reflection as well, because maybe some big trade happens and then it
Yeah,
spoils the
don't.
whole thing.
Yeah, yeah. My strong suggestion. Oh, okay, so before I say what I say, let me tell you. So when I started because I saw someone doing it as a side gig and making a lot of money. So that got me attracted. I had beginner's luck, made a few successful trades that pulled me into it, and then I had a few years where I was like, one step forward, two backward, maybe three backward sometimes, and I accumulated losses slowly, but I accumulated losses for first few years. And part of the reason was because I was trying to trade time frame, shorter time frames for quick gains. I was just working with a mindset that, oh, I need to make 500 this month or 1,000 that month, that kind of a mindset. If you work with that mindset, then you tend to miss the big picture. And in this market, it is a mistake to miss the big picture because, see, the one truth about this market is that the losers fund the winners. There is no new money coming from anywhere else. No government is giving the winners. So if there are winners in this market, who's funding them? It is people who lose money. They are funding them. So in order for us to have a chance of a consistent success, we've got to be very careful with our
There is a
money.
lot of background noise on the back. Can somebody mute
Sorry.
the screen? Yeah, please.
So, so yeah, I think if you look at minute, it will be for me it gives a giddy feeling because sometimes it moves so fast that it's even hard to understand what's happening. So some people, there are people who specialize in trading only the news. They don't do anything else. All they do is look at the news. So when news comes out, they will trade indexes, they will trade currencies, they will trade other commodities based on the news, and they make money because they have learned it. They have mastered that art of trying to predict if, for example, if interest rates are in this band, then how the markets will react. So they have created models to give them the prediction, and they win that way. For people like us, I think, and we are doing this as a side gig, and we are putting our hard-earned savings to try and make a little bit of profit. My strong advice and suggestion is to kind of tread vehicle very carefully, look for real value, invest for slightly longest term. Yes, I mean I do take profits, by the way. I'm not like Sandeep ji, who's willing to. I don't know how he sleeps when he makes hundred thousands in a day and still not take profits. Um, but people have their own styles, and he's I think hats off to him that he's able to do that with some conviction. My suggestion is that each one of us, based on our risk appetite and personality and our response to fear and greed, we have to come up with our own a little method. And once you have come up with a method, just stick with it. That's the most important thing. Discipline is indisciplined people get punished in the markets, and the only way to know whether it is punishing you or not is your account.
I think one of the important thing with these reading things, I would say, I mean, I have always been a huge believer of the fundamentalist myself.
Yeah.
But after today's session, I mean, I think if you use these things in conjunction with the technical analysis, these things can be very
Yeah.
useful.
So,
But
so
a very important caveat is also that one should not be a compulsive trader. No, don't look for trend. If the trend is there, I think it will
yeah,
show up on itself.
yeah,
Don't try.
exactly.
We should not try to make up something just for the sake of it.
Very good point, sir. Very good point. I think I completely agree with you. This is only a tool which should be used as an aid to making decisions, but the decisions should not be made solely on this basis. There's a uh, lot else. First of all, fundamentals. You have to see the value in what you're buying, and then it has to be aligned with your own risk appetite. How much you're going to risk per trade, uh, and how whether you want to diversify and you want to limit the size, because sometimes what happens is, and it happened with me a lot, that my winners were very small quantities, and the moment I tried to kind of scale up, i had a I had a loser, and sometimes I had five winners and then one loss wiped all the five winners. So uh, but I've learned my lessons that
That's a story of every retail investor. Trust me.
yeah, yeah, which is why the size with which you trade is very very important. You have to be consistent
Sure.
for a period of time. Don't change it, because if you
Mhm.
change it, then the moment you change it, if you reduce it, you'll get a winner, and if you increase
Yeah.
it, you'll get a loser somehow. I mean, the market
Absolutely.
knows. So
I
uh,
like that.
I had a question. You talked about red candles and green candles. I read a lot online. A red candle has appeared, which shows a bullish trend. Is that the same as this red candle? Because this one is
No, no,
not.
no. That red candle that we talk about is one of the one of the I listed six or seven different types of patterns. It's one of those.
Okay, okay. So
Yeah,
you'll come later. Fine.
yeah, yeah, yeah,
Thank you, thank you.
yeah. Okay, so I think we'll call it a day now, and I think we will do another session at some point where we can look at some more live charts, p- hopefully of things that are of
Yeah.
interest to us. The like the Teslas and the Sophies and the Palantirs of this world.
Okay. Yeah, that's great.
Great.
And
Thank you very
we
much,
see
Jaidev.
Thank
We
you
really
so much,
appreciate it.
Jaydev.
see some of you face to face on Saturday. Yeah.
Yeah.
Yeah. Yeah, see you
Yeah,
guys
Yeah,
next time.
sure.
Yeah.
Thank
Thanks,
you very
Ankur.
much.
Thank
Thank you
you.
for
Thank
the
you.
insights.
Bye.
Thank
All
you very
right,
much.
guys.
Bye.
Thank you.
Good night.
thank
Good
you.
night.
Thank you
Take
so
care.
Bye
much.
bye.
Good night.
Bye bye. Bye bye.
Thank you.